Hi everyone, welcome to my channel. In today's video, we'll be discussing the topic, how do I select stocks? So this was one of the questions that came from one of my friends and subscribers to this channel. So I'm going to discuss how do I select stocks in this video. Let's jump into the video. So the first is there are two methods to how I select stocks. The first method is a systematic way and the second method is a discretionary way. The main difference between these two methods is that one is purely objective, meaning that it is completely based on rules and there is no element of human judgment involved. So the system based on rules, the system will tell me what I have to select, how much to buy, when to exit, when to book profit, etc. Everything is rule based and it has been back tested on historical data, and I also know that like on an average how much this system would give me returns, so that my expectations are also in line with the system. Like it has been already back tested on like 15 years 20 years of data, so I know on average when the system would go on a drawdown, or like how much is the average returns per year. So all that is known previously because it is purely based on rules and objective rules, so it has been already tested. The second method is discretionary method. So it is based on subjective, like it involves an element of human judgment, primarily because there are a lot of signals or a lot of stocks that will come as signals in your like if for example if you are using a breakout system, whenever you scan for breakouts, there will be a lot of stocks that would match this criteria, and in that case you will have to use your human judgment to select few stocks from that particular signals that you have got. So because you are selecting from some of the signals, there is an element of human judgment involved and it is not completely objective. So but the commonality between these two methods is that in both these methods aim to ride the winners and minimize your loss. So the objective is to have smaller losses and to have bigger gains. So that is the only way to be profitable. And like for example the systematic method, there are only it's only accurate 50% of the time. Suppose that is, if I take 10 trades, 5 of them would be resulting in losses and 5 of them would be giving me profits, and this is over like a lot of trades. Though you might think how come a system that is only 50% accurate give you profits? So the system is designed in such a way that when we lose small, and when we gain big. And this is called as positive expectancy in trading system. So this is how we ensure that we remain profitable by using a systematic way. And even in discretionary trading trades that I take, I aim to keep my losses small. So I have stop losses, and then I will trail the stop losses to ensure that I don't give up my profits. These are the two primary methods. So we'll go a bit more in detail about what is the systematic rules and what is the type of discretionary trading that I do. So let's first look at the systematic method. So the systematic method or the rules based method is there are a number of styles or number of styles on which the rules can be framed. Like some of them are like trend based systematic trading rules, and some are based on momentum, and some are based on mean reversion. Mean reversion meaning that nothing keeps going up higher and higher. At some point of time the price has to mean revert or come towards the average price. So this is called as mean reversion. But among all these factors like trend, momentum, growth, mean reversion, momentum has been shown to be one of the most profitable and one of the most reliable way to design a system, and that's the reason why I have chosen momentum as a factor for designing my systematic way of choosing stocks. So there are a lot of academic papers that discuss how momentum has been absorbed in stock prices. So momentum is nothing but it defines how quickly and with what magnitude a stock price is moving. So a stock will move only when there are big players like institutional investors or big people with big money enter that particular stock. So when these people enter a particular stock, they tend to drive the stock price up and at a faster rate. So we have seen this in a number of AI related stocks, because all the investors have been chasing AI stocks, AI chips companies, and a few years back they were all chasing like EV related, electronic vehicle related stocks like Tesla and all these. So the stock prices all show a momentum where you can see kind of like a parabolic move in the stock price. So this is called as momentum. And I have already made some videos on momentum. You can check it out, where I've described momentum indicators, what is momentum and all that. So for the purpose of this video, I'll cover like what are the elements involved. So for the first one is the universe. Universe is nothing but the index that you want to look, where you want to look for the momentum stocks. Like it could be like S&P 500, Nasdaq 100, or it could be NSE 100, or it could be ASX 300, or it could be a minor subset of index like NSE mid and small cap 400. So universe is nothing but the indices where you want to scan or run your rules, like where you want to find which are the top momentum stocks and what to buy is the next element. So you can define, like you can select like top 1% of the cohort. Like you can see like among the Nasdaq 500, you can select like the top 1% where you want to select and invest, and you can actually rank them, because momentum is a number that you can calculate. You can actually rank these stocks based on their momentum and find out their relative momentum. And then you can choose between, like you can choose like if you are choosing 10 positions as this one, you are having each position as a 10% risk, and if you are choosing 20 positions, you will have a 5% risk in each positions. So for example, in ASX 300, where I invest my super or my retirement funds, I run a system where I select 5 stocks from NSE ASX 100 index and 5 stocks from outside the ASX 100 index. So I kind of mix and use a combination of indices to select 10 stocks from, like 5 from ASX 100 and 5 stocks from outside the ASX 100 index, like removing the top 100 largest market cap companies. I select, you are left with 200 stocks, and then you can select 5 from that. So that's how I have defined my retirement fund. So in that case, I have a risk of like, I have 10 positions, so I have 10% risk per position, and when to sell. And these are also based on rules. So when there is a lack of momentum, or when the stock exits from the cohort of top n%, like 1% cohort or like 2% cohort, means it's no longer the strongest moving stock. So your money is no longer the strongest moving stock. So you tend to exit that and then redeploy that money in another stock which has entered that cohort of strongest momentum stocks. So this is how. And in terms of loss as well, I have defined particular stop losses where it will exit if that particular stop loss is hit. So as you can see from this, that everything, like where you want to trade, how much, what you want to buy, and how much you will buy, and when you will exit a particular stock, is all based on rules. There is no element of me going and selecting between these stocks. The system tells me buy these 10 stocks, and it will tell me when to exit each of these 10 positions. So it's completely rule based, and there is no element of human discretion or judgment involved. So that's why it's called as systematic method. So the second method is the discretionary method. So discretionary method is slightly subjective, or it's where your human judgment is involved. So for this style of trading, I have only like 20% that I mostly do for discretionary type of trading. And even within the, you can apply discretion on top of your systematic. Like you already have positions in some of the systematic portfolios, right? And on top of that, like suppose I have 10 positions in my systematic portfolio, and then I can scan these particular 10 stocks to find out any breakouts that are going to happen, or any trend continuation that are going to happening. I'll make one more video where I'll show you with chart examples how I look for trend continuation and how I look for breakout patterns. So, but coming back to the video, like on the discretionary method. So discretionary, there are like certain chart patterns like breakout or trend continuation, which shows like they have a higher probability of moving in the right direction. Suppose there is a stock that is forming a large base and is now trying to break out of that base. There are a number of like it has been shown in the past that these kind of breakouts give a high probability of success. Like the stocks, when they come out of a large base, they tend to move with a stronger momentum in the right direction. And when it comes to trend continuation, there are certain patterns that are frequently observed in when the uptrend is continuing. So like you can say like a flag pattern, a wedge patterns. So I will make a separate video on these chart patterns that I commonly use. So, and this is how I look for these chart patterns in my existing positions in my systematic portfolio, as well as I tend to scan for these particular chart patterns and for like the strongest trending momentum stocks, and then look for chart patterns in those momentum stocks as well. Like I look for breakouts and I look for trend continuation patterns to take positions. Hope you found this video useful. If you have any questions or doubts about these two methods, please do drop your questions and I will make subsequent videos to clarify your doubts as well. Thank you for watching. Please do consider subscribing to this channel. Thank you.